This is your step-by-step guide to calculating the Australian age pension. I'll use an example to walk you through the assets and income test, and along the way, share some tips and strategies on how to increase your pension. Stick around until the end to get the exact Excel spreadsheet so you can get a head start on your own calculation. Let's dive in. Once you meet the age and residence requirements, how much age pension you can get is determined by the assets test and the income test. These two tests work independently, each producing an outcome. The test that results in the lower pension amount will determine your payment, while the other test is ignored. Let's work through an example together. It's a pretty comprehensive one with lots of interesting aspects to explore. Meet John. He's 67 years old, single and a homeowner. He works part-time and earns rental income from an investment property. John has a mix of financial and non-financial assets, along with a balance on his credit card. The first step is to identify the rates and thresholds used in the calculation. This depends on your relationship status, whether you are single or part of a couple, and whether you are a homeowner. In the Excel templates, I've included the latest rates for all scenarios. However, to calculate for a specific situation, you only need 4 key numbers. Since John is a single homeowner, we need the full fortnightly pension rate for singles, the lower asset threshold for single homeowners, the lower income threshold for singles, and the deeming rates applicable to singles. For easy reference, I'll put these figures next to our example. Let's start with the asset test. There are generally 4 types of assets. Some assets and liabilities are not assessed in either the asset or income test. Some are assessed in only the asset test. Some are assessed in the asset test and also deemed to contribute in a set way towards the income test. Some are assessed in the asset test, but they are not deemed, meaning there is a unique way to assess their income. Let's review John's assets and liabilities. John's family home is worth $800,000. He owes $200,000 on his home loan and has $80,000 in an offset account linked to it. First, the value of John's family home and the home loan balance are excluded from the asset test. However, the $80,000 in the offset account is treated like cash in a normal bank account, so it's included in his assessable assets and counted in the income test under deeming rules. Let's pause a moment and think about strategies to boost age pension based on the rules around the principal residence. Since the family home isn't counted as assessable asset and the home mortgage does not reduce assessable assets, John can consider using his financial assets for home renovations or paying down the mortgage. Now let's have a look at his investment properties. They are treated differently from your principal residence. They're included as assessable assets, but only the net equity is counted. This means the market value of the property minus any outstanding investment loan. A tip here is that do not secure your investment property against your family home. If this is the case, the value of the mortgage will be disregarded and your age pension will suffer. From Centrelink's perspective, investment properties are considered non-financial assets, therefore not subject to deeming. We will discuss how rental income is assessed under the income test section. Home contents and motor vehicles are considered non-financial assets and they are only assessed in the assets test. It's important to know that Centrelink assesses them at market value, not the original purchase price or replacement cost. Most people do not have more than $10,000 worth of furniture and personal effects, but many mistakenly report the insured replacement value or a sentimental value. This can unnecessarily reduce their age pension entitlements. If you have done this, update your figure with Centrelink to ensure you're receiving the correct payments. To estimate the market value, check platforms like Facebook Marketplace or Gumtree for similar items. Another misconception is that Centrelink will apply a rate of depreciation on assets on an annual basis. It does not. You will need to do this yourself. It can be a very worthwhile exercise because if, say, your computer or car depreciates, your total accessible assets should reduce. If you update your figures with Centrelink, you might then qualify for a higher pension payment. If you have a car loan, credit card debt, or other consumer debt, remember that this don't reduce your assessable assets. Using available cash to pay them off could be a smart move. For John, the non-financial assets that are not subject to deeming are the home contents, plus motor vehicle, plus the market value of the investment property, minus the investment loan. This gives us $180,000. His cash in the bank, term deposits, shares, ETFs, managed funds, superaccumulation accounts, account-based pensions, and offset account are all financial assets subject to deeming. We will discuss deeming later. The total of these is $499,000. So his total assessable assets are $679,000. Since John's total assessable assets are above the lower threshold, he won't qualify for the full age pension. Next, we will calculate the excess assets. For every $1,000 of excess assets, John's pension is reduced by $3 per fortnight. This results in a reduction of $1,095 from the fortnightly full age pension amount. The pension amount he is entitled to based on the asset test is a full pension amount minus this reduction, which comes to $49.40 per fortnight. Next, income test. John earns $12,000 per year. Dividing that by 26 fortnights in a year, his fortnightly part-time salary is $461.54. To encourage people to continue working without significantly reducing their pension, the government provides a work bonus. This includes $300 per fortnight with a starting balance of $4,000. We will convert it into a fortnightly figure, and the work bonus is $453.85. This amount will be used to offset John's work income. When it comes to deemed income, Centrelink assumes financial assets earn a certain rate of return regardless of the actual income they generate. For John, this means that out of his total $499,000 in financial assets, Centrelink assumes the first $62,600 earns an income at a rate of 0.25%, while the remaining amount above $62,600 earns 2.25%. The total deemed income is then divided by 26 to calculate the fortnightly figure. When it comes to rental income from investment property, Centrelink includes the net rental income in its calculations. This means the gross rental income minus allowable deductions. However, not all ATO deductions are allowed by Centrelink. You can deduct loan interest payments, rates, and maintenance costs such as agent fees and insurance premiums. You cannot deduct capital depreciation, special building write-offs, and so on. If your rental property makes a loss, Centrelink will treat the income as zero. You cannot offset this loss against income from another property or any other source of income. In John's case, the net rental income is $10,000 per year, dividing that by 26, giving a fortnightly figure of $384.62. To calculate his total assessable income, we take his work income minus the work bonus, plus deemed income, plus the net rental income. This gives a total assessable income of $775.98 per fortnight. Since this amount is above the lower income threshold for a single person, John's age pension will be reduced. The excess income is $564 per fortnight. For every $1 of excess income, the pension is reduced by 50 cents, resulting in a reduction of $282. John's pension entitlement from the income test is the full pension minus the reduction equals $862.41 per fortnight. For John, the asset test produced a lower amount, so this will determine his age pension. This means that if John wants to improve his age pension entitlement, he should focus on strategies to reduce his assessable assets rather than reducing his assessable income. For example, for him, stopping part-time work or increasing his rental income deduction won't make a difference. However, using his available assets to pay down his home loan would significantly help. Now you know how to calculate your age pension entitlement. Check out this deep dive video where I show you many more strategies to increase your age pension. Thanks for watching. I'll see you in the next one.